Well, hello and welcome to Fidelity Soundbites, a straight to the point monthly podcast where you will learn from some of Australia's leading portfolio managers on what's happening in markets, how they're positioning their portfolios, and the outlook going forward. I'm your host, Andrew Dowling, and thanks again for joining us. James, welcome, and great to have you on board again.
Thanks, Andrew.
Now, first and foremost, I must say congratulations on your recent 10-year anniversary since you launched the Fidelity Future Leaders Fund, July 2013.
Yeah, thanks very much, and thank you to all the clients that have been there for the 10-year journey. Look, I'm very proud of what we've achieved over the decade. We've gone through a lot of up markets, down markets, pandemic, etc., but we've still delivered around a 10% after fees compound return per annum for clients over the last 10 years. For me, that's a great outcome that I've wanted to achieve since inception, and we've got there, which is fantastic.
Yeah, very much so. And look, just thinking back to when you launched the strategy 10 years ago, and I even remember from our conversations, most of the focus from the market in terms of what they wanted to see was an Australian small cap strategy where you were very much and continue obviously to be very much focused on the Australian mid and small cap market. What was it? What were your observations back then? What were you sort of seeing that maybe wasn't being observed more broadly by the market? And what I suppose the driving factors that took you down that path?
Yeah, no, very interesting point, Andrew, because I was told too, you need to launch a small cap fund. That's what everyone does. And I had the actual about 10 points to the head of research and the head of investments globally then to say, look, this needs to be a mid-cap fund. The return on equity of the mid-cap area is higher than small caps, and we've proven the last decade small cap return on equity and total return is around 5 or 6%. And the return on equity and the total return for the mid-cap index is around 9. That's a very big difference of that 4% difference between small caps and mid caps has meant a very different outcome for the fund being mid cap skewed. Obviously, the best top quartile performing funds in small caps still do deliver that double-digit return, but being mid-cap focused means you're getting that with a bias because your benchmark is much more mid-cap focused. So I'm very happy to see that, and I showed that chart in the recent T20s I did last year in the webinar today, that we did look at the ROE and the total return. They are very heavily correlated. And that was something I looked at and learned before when I did the pilot and said, no, definitely this will be a mid-cap fund. So, yeah, very happy that that we've chosen that as our benchmark and it will give clients a better return outcome over time.
And, James, over that time, you've had small-cap companies graduate into the mid-caps and mid-caps graduate into large caps. Talk us through, that process of identifying companies that, obviously graduate into, the real future leaders of tomorrow.
Yeah, look, future leaders is what the fund's name is. That's what we try to find. It comes back to what the process is that I have the VSC. So viability, sustainability, credibility. If those are high, so if your ROE is, say, 10 to 15 and it's very sustainable, the market structure is supportive, your sustainability in terms of the ESG parameters and your mentality and the markets are helpful for sustainability, that helps. And then credibility of your accounts, credibility of management, and credibility of how you present yourself to the markets. That is all very important. If that's there for 5 to 10 years, you will become the future leaders of tomorrow, the large caps of tomorrow, which have become Qantas, which have become James Hardie, which Sydney Airport, ResMed, Pilbara Mining, which is a lithium stock. These are the stocks that have graduated into the top 50s, and they're the characteristics that those companies have. And when you have them over a decade, the returns on that profile is just phenomenal. And the stocks that are still in the fund have been big contributors, have been WiseTech, Altium, ResMed, Fisher & Paykel, Pro Medicus. All of them fit that profile, but they're still within our universe. But those that have done very well contribution-wise and graduated have all those similar characteristics. And that's why the process is what it is, trying to find those.
And now we take a step back. Let's say we jumped into the DeLorean right now and we go back to the future. What advice would you be giving James Abela back in July 2013 when the strategy launched?
Yeah, that's a good one. Look, there's probably three big things. One is quality stocks are beautiful compounders, and if you can find those and just simply hold on to them with patience, you can make a lot of money. And when I look back over the decade returns, the bulk of the top 10 have been those stocks. So ResMed, Fisher and Paykel, Pro Medicus, Altium, WiseTech. The next category of stocks are those that are just earnings explosions, or you have huge earnings growth behind them. So things like Pilbara Minerals. So it's a momentum thematic, which is really a huge theme. So whether it's lithium, I've also got from 2017 and 18, 19 was A2 Milk, and Blackmores and Bellamy. So that was really the export to Asia, which is a huge thematic. And there are themes that come through, and if you miss them, you miss a whole lot of opportunity. And then the third category stocks are the more annoying ones, which are these sort of momentum thematics, which are really either loss-making or concept-based, which is where all the pain mainly comes from. So stocks like Afterpay really hurt the fund, and they can be very flippant in terms of how they re-rate themselves. They can be very, very quick, and there's not a lot of earnings support generally. There's a great story behind them. So definitely they're the three categories of stocks that I've seen, but the majority have been in that category 1, category 2, so high quality compounders and those momentum stocks where there's earnings upgrades. But those story stocks and those story themes and groups can also be a big land of opportunity as well.
Thank you. And from back to the future, back to the present, where we find ourselves today, your, I suppose, for want of a better term, your market mantra, certainly in recent times, has been earnings, earnings, earnings. Is that still very much the case? Is that sort of how you're seeing the current mid and small cap market in Australia?
I think, look, the last 3 to 6 months it has been. I'd probably say there's an element, there's further elements to that today. So if you're a high quality stock on a high PE, it is earnings, 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 because that drives what the multiples are. But the last, 3 months, especially the last few weeks, it's just been earnings, certainty, and visibility. And that has been enough. So just yesterday, Baby Bunting, which is a retail stock, retail's been horrible overall, but the winners and losers have been, very, very big differences. But Baby Bunting came out, just said top of guidance is our new guidance, and the stock was up 20%. Temple & Webster came out and gave good guidance, and the stock is up like 50% in the last few months. Compare that to the ones that aren't doing well, that have earnings downgrades, and they're down 30 or 40%. But the ones that are providing earnings visibility and certainty, Megaport's another one. Stock's up 80% in the last 6 months. SDR SiteMinder is up 20, 30% in the last few weeks. So if you're in that momentum category, which last year got really hammered, really hard, some of them 60 to 80% down, and you come out just with earnings visibility certainty, your stock has been up between 20 and 60%. So I'd say if you're quality stock, it's earnings, earnings, earnings. But if you're more momentum or transition, those three elements are enough of earnings, certainty, and visibility.
And so, once again, for want of a better term, not everyone's got a nice big mortgage balcony in front of the mortgage cliff. People are still coming off fixed rates. Obviously, the momentum of rate increases has slowed down. Is that sort of where people are starting to gain some, I suppose, comfort, visibility around, sort of what their comfort level with rates is? Or
Yeah, I'd say it is. Yeah, it's probably two groups of thinking. One is the fact that we're at peak inflation, peak rates. So rates were put on hold last few days. Rates around the world, so the US, Australia, and in London have all basically almost, feels like they're almost stopping, because the increment has slowed down. So they've gone 50 to 25, and also the signals are now changing to be kind of let's just wait and see what's happening. I'd say that's the side of that. So that's the inflation and rates kind of side of it. The other side of it is that we haven't had, in Australia particularly, massive profit warnings or very significant consumer pain. People have shifted spending, people have slowed down spending, but there hasn't been a big a big mortgage cliff. The banks have mentioned they have more debts in arrears, but it's not like a massive uplift yet because we haven't had unemployment lifting yet. Unemployment's still in the 3%, 3 to 3.5%. It's very, very low levels. Immigration has just begun. All these things are potential things that could happen and potential things could change. But that's kind of where the market set is. And therefore, in the stock market, what's happened is market's gone from fear of recession and just general deeper fears, where momentum got really, fell down, quality got very derated. And now we've moved to potential soft landing and all those things coming together, consumer not collapsing, peak rates, peak inflation. And that means we're more in the middle market in terms of the mindset of investors right now, which is allowed duration to go out, has allowed valuations to go out. And that's what really has lifted the market upward. I mean, the market's up nearly 10% year to date. So it's, and the NASDAQ's up 30-40%. So like a lot of things have come back. All those big tech companies have come in with pretty strong results. So there's a lot of, I guess, positives that have come out. It is more relief. And there's certainly a dichotomy in the market where some investors think this is the beginning of the bull market, and some are taking the view that this is the last sort of hurrah before we actually get the recession. And certainly economists are saying, well, the market's looking a year ahead, thinking it's not that bad, which is more the soft landing cap. So you've definitely still got a mix. It's not all one direction at the moment. Yeah. It's still a very mixed view on the market, and that's why it is still very, very stock specific. Yeah. Like there's no sort of easy money, easy wins being made. Everything sort of has to be earned, and that's where we are in the market. Yeah.
So when to your point around earnings, particularly the value quadrant of where you invest, what does that look like? How do you then in this environment where things are potentially moving to more of a soft landing footing? How do you sort of trawl through that quadrant of the market and what's on there that you like and why?
Value is definitely like a bigger chunk of the portfolio if you roll back six months to 9 months. Now it's a little bit of real estate. Orica's one that I still think is value. CSR I own, which I think is value, where the earnings are pretty stable. Whereas if you roll back 6 to 9 months ago, there were stocks that I didn't own that I thought were value, like Incitec Pivot, which have earnings that are minus 15, say minus. So they're minus and minus if you look out 2 years. Those stocks were actually working and running on the back that they were low PE. Now it's harder for companies just to work because they're value stocks or because they're low PE. That's where I say you need earnings, you need visibility, and you need certainty. And if you're getting a risk of margin or a risk of the outlook being worse, those sort of traditional value stocks aren't really working. But those where the earnings are flat or incrementally rising, then they're the ones that are doing a little better. But as a focus, it's definitely, I guess, a smaller part of the portfolio. It's about 12% of the portfolio today, whereas it was a bigger portion, say, 6 months ago.
Great. Thank you, James. And obviously, as we enter reporting season, the early stages of reporting season, lots of discussions and meetings ahead as we go through the month. And, naturally, we'll follow up with your thoughts and observations next month.
Thank you.
Thank you. And, well, thanks again, James, and we look forward to catching up again next month.
Thank you, Andrew.
Well, we trust you've enjoyed today's episode. Please subscribe to the podcast and make sure you send your questions to podcastaustralia@fil.com. Otherwise, we will see you next month to talk about August reporting season results, and take care until then. Goodbye.
Please remember that past performance is not a reliable indicator of future performance.
Some important information on today's podcast. This podcast is issued by Full Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.